Tao in Chinese simply means the way. As a philosophy, it is to find balance and harmony with the universe. Welcome to the Tao of Chao podcast. This is a podcast about macroeconomics, geopolitics, global finance, investment themes, retirement planning, and behavioral finance, where we will try to find balance and provide a clearer path forward in this uncertain world. I'm Philip Chow, your host. Each episode, I will feature an industry guest, a person in the trenches, a practitioner, to discuss a relevant topic in which my guest has expert knowledge and wisdom. I'm delighted to have Mr. Jason Singer, my friend, as my guest. Jason is partner and global head of product development and innovation in the Client and Product Solutions Group at Apollo. Prior to joining in 2021, Jason worked at Goldman Sachs Asset Management for 22 years. At GSAM, he was the managing director and global head of product, leading the public capital market team within GSAM's retail client business. Actually, that's where I met Jason. Jason also held various portfolio management and business development leadership roles across the global fixed income team. He's a graduate of Whitman School of Management at Syracuse University, where he served as an advisory director and earned his master's degree in mathematical finance from Columbia University. Finance is tough enough. Mathematical finance, I have to give some thought to that. So Jason, as you know, so welcome, Jason.
Thank you. A pleasure to be here. Appreciate it.
Thank you. Jason, as you know, people call me a wealth manager. I do portfolio construction and that type of thing. And I use alternative investments when constructing my client portfolios. So for our audience, I'd like to first sort of set the stage with a really brief intro about alternative investments and what are the differences between sort of the public market and private market, things that you and I take it for granted. And I'd like to see if you can share some, basic thoughts on what is alternative, what is public, what's private, and what makes it alternative.
Yeah, well, Philip, I just want to say it's a pleasure to be here. You are a good friend, a long-standing friend, and just an absolute pleasure to be part of this. So, it's pretty simple. At the end of the day, when you think about alternatives used to mean something that were scary, locked up, a lot of leverage, you couldn't get back your money, and so on and so forth. From our perspective, when we think about what an alternative is, all it is an alternative to public stocks and bonds. So when you think about the universe today, right, and you think about diversification, you think about building better portfolios, about 80% of companies are private, the balance is public. So from our standpoint, when we think about alternatives, it's just public stocks or private companies or private debt relative to that of public debt or public stocks.
Interesting. So alternatives, almost like the other part that's left out from most people's thinking about investing in stocks or bonds or debt or what have you. Jason, I know since global financial crisis, the private space got even bigger. The private space got bigger because it's my understanding the U.S. government through the Federal Reserve or whomever have curtailed the amount of activities a commercial bank, which used to have the ability and access to provide financing or support, was no longer available, which gave further rise to this space. Can you talk a little bit about how much has that influenced the private space and the future looks more like the last few years, or it's going to be somewhat different?
I think it's going to be more like the last few years where there's going to be a lot more adoption around alternatives. So let me just give you some numbers. If you look at, let's say, high yield issuance or loan issuance on the public side, you've seen high yield issuance year over year down about 13% and loan issuance down over 40%. But when you compare that relative to private credit is up over 100% of the year.
Wow.
So you are finding a lot more companies are turning to alternative asset managers for certainty of execution, be it on the debt side or the equity side. So I think, Philip, to your point, you're going to see more and more companies turn to the private markets over time.
And they turn to private market. Are they getting better terms, or they're getting faster money funding? What is it that is it the only source left for many of them? Or tell me about the attractiveness from lending or
I think
borrowing.
that there's a lot of reasons, but I think probably the number one reason is the certainty of execution, right? If you need financing, you want a partner that could give you certainty of execution with fair terms, and that's why you're seeing a lot of money go to the private markets.
I see.
Versus if you think about the public side, at times, if you start to see markets become volatile, it might be very difficult to get that certainty of execution.
So there's also another trend for a while now. There are fewer and fewer companies going public, and more people using private avenues to raise capital and so on. Can you talk a little bit about that as well?
Yeah, I mean, I think we've been seeing this trend over the last 20 years. Over the last 20 years, you've been seeing less and less companies willing to go public. Like if you think about it, and to my earlier remark, you used to have a lot more of the population trying to go public, but the companies are staying private or staying at private for as long as they can because it's just easier. In addition to that, there's a lot more regulatory burden associated with a company to the extent that they're public versus being that of private.
And is that a global phenomenon or more a U.S. or developed market phenomenon?
It's global.
It's global.
That's correct.
So the opportunity set, it sounds like, has significantly expanded. I mean, relatively speaking for investors, because now we can reach into otherwise less liquid, in that sense, less available to investors. And through firms like Apollo and others, that is becoming more available so that we have a bigger opportunity set. Would that be a fair conclusion?
I think you're spot on. And I think the opportunity set is broad, right? It's not just call it credit. It's not just private equity in a classic sense. It's really all asset classes. So like from our perspective, it's anything from credit, and that could be investment grade or high yield. That could be anything in the real asset space, and that could be infrastructure. That could be sustainability. That could be real estate. And then last but not least, that could be in the form of equity or to private equity.
Fantastic. So whatever is available in the public or liquid market, it can be mirrored in the alternative or private market. I mean, almost. Is that a fair?
Almost. And I think that's really what we're starting to see as a trend. And that's why, like when we think about end consumers or end investors, we do believe to build better portfolios. If you're trying to really get a truly diversified portfolio, you have to be in the private space alongside that of the public space.
So when I talk about alternatives with clients or with folks in the industry, some people are just kind of, I don't know, I'm not sure this is right for me. We're going to get into that a little bit in a moment, because we're going to ultimately talk about democratizing, right? We're ultimately saying, this is good stuff, let's share it with more people, right? And how we go about doing that, because certainly there are some barriers to entry. But in the meantime, so thinking about alternatives, one of the things that people always get excited about alternatives or private market is it has demonstrated outsized returns, and our returns that is better than what is typically available on the public market. No, I don't want to make a like always all the time. I'm saying that's the impression, right? And you see a lot of institutions. I'm talking about sovereign wealth funds and pensions and all those companies that you know about have been investing in private market for a long time. Alternatives. Can you tell us a little bit of why that is the case? I have some ideas, but you know a lot more about the private market space. Tell us about why that is the case.
It's all about alpha. It's all about alpha, Philip. So exactly to your point, I'll take your last point first, which is if you think about institutional investors, be it corporate, sovereign wealth funds, et cetera, 10, 20 years ago, they might have had 5 to 10% allocations to alternatives in the classic sense. And again, alternatives being broad private markets. Today, those institutions have 20 to 30% of allocations to private markets. Now, when you think about high net worth clients to mass affluent, generally in the ultra high net worth, a couple of years ago, that percentage was 0 to 1%. Currently, it's about 5%. But when you look at the mass affluent segment in today's environment, that's still closer to 0. But again, over time, we think that's going to change. So that's point number one. But going back to my earlier point, which it's all about alpha, which is a lot of institutions that invest in the public side, be it equities or fixed income, they've recognized that their active managers have not been able to produce consistent and persistent alpha. So you've seen a lot of that flow move to beta, and that's why you've seen the rise of ETFs. ETFs, be on the debt side or the equity side, has continued to grow assets, while you start to see active mutual funds continue to shed assets because of the fact that active alpha is hard to come by. And just to give you some numbers, when you think about an active public markets manager and you think about the difference between a Q1 performer and a Q4 performer, the delta or the difference is about 200 basis points, right? So there's not a lot of variance between a Q1 and Q2. If you look at that same stat in the private markets world, it's somewhere between 1,500 to 2,500 basis points of alpha. So like from our perspective and what we've seen, and exactly to your point, Philip, we believe that there's a lot of alpha to be had in the private market. And that's why you're starting to see a lot more clients from institutional all the way out to the mass affluent trying to get exposure access to this broad asset class.
So let me just define what my definition of alpha is. We're manager adding value that is above the beta, which is the market systematic risk of the market. Above that, what kind of additional return you can get. When you talk about 1,500 basis points, is 15% above what comparable risk in theory can drive in a public market. Am I saying it correctly?
Yeah, so I'd say a couple of things. That was just more around like managers and active management, that 1,500 to 2,500 relative to, let's say, a Q4 performer. Yeah. But Philip, to your point, thinking about the excess returns of the alpha over public market equivalent, you're looking at anywhere from 500 basis points to double to triple that over time.
Yeah. And so we can go deeper into this alpha, because alpha is what everybody's looking for. And this is why managers get compensated, because the manager or manager group or management group is able to demonstrate that above average return for a client. So part of the discussion about looking backwards to go forward is that, hey, we have been in an extraordinarily low interest rate environment. I'm going back to your fixed income days for a second, Jason. I apologize. I have to keep pulling you back to that. The cost of money is almost zero, if not less than zero. In real rates, it's less than zero. And the whole point of the monetary authorities globally is to push us to take risk. Go take some risk, and go invest, go do whatever, go borrow, go whatever you can do to bring the economy back up. And since the global financial crisis and with COVID, it's been over a 15-year period that we've been in this extraordinary period of just lose money, and that it doesn't take much imagination, because leverage is wonderful if you can have it at zero cost. Going forward, that reality may be somewhat different. It's certainly different today. I don't want to project 10 years from now, because I cannot even project tomorrow. But what I can share with you is that chances are we are at this moment in a different regime. So tell us about under this regime where, of course, risk has to be repriced. We saw the repricing last year with the public market. Is that repricing also going to cause some havoc for the type of overperformance we have been expecting, some of it which is leverage apparently, or maybe not, going forward? Can you talk a little bit about that, and what certainty do you feel about the future?
No, I think you're right. I think during a period of easy money, you take a dart, throw it at a board, and odds are you're going to do okay, right? Be it beta, be it non-beta, odds are you're going to perform well over that cycle. I think that's why, from our perspective, two things I would say. Number one is it really is about a firm that could, on a consistent basis, produce alpha, to my earlier comments, Philip. But the second thing about all this is that purchase price matters. Be it on the public side or certainly on the private side, purchase price matters. And it's really important to stay patient, look for the opportunity set when it exists, and for us to really think about where we want to deploy our capital. But I think you're spot on, which is it's really important that as clients evaluate managers, they should be evaluating managers. Are they managers that perform well when just beta does well? or they are a manager that can perform well over a full market cycle and be an all-weather manager. So again, from our perspective, as we think about credit, we think about debt, we think about everything in between, it's really about recognizing that purchase price matters.
So entry point is what you're saying.
Exactly.
And I think we're going to eventually use the word vintage, but that's kind of another thing that we're going to talk about.
Are we talking about mine and your vintage from an age point of view, or are we thinking about from a private market standpoint?
Depends which ones strike our fancy at the moment. So let's think a little bit about private equity. Private equity is quite straightforward by definition. Is privately investing in equity of a firm, either taking it away from somebody else or carving it out and what have you. So that is basically investing in a company, potentially giving them some management help, some distribution help, some other assistance to make them even better than what they are, and then hold on to it for a period of time and then letting them go. Is that how private equity can be thought of, or what am I missing here?
I think that's right. I think broadly defined, Philip, I think you're spot on.
So
apologies, and just going back to my earlier comment, which is when you think about investors and the choices that they have, right? Yeah. You can invest in public companies or private companies.
Yeah.
And I think, to your point, especially given the fact that so many private companies are privately held, from our standpoint, portfolios should include private equity and private company risk within a broader asset allocation schema.
So under that schema, we also want diversification, right? So you typically commit a certain amount of money to a firm like Apollo and say, okay, I want to allocate this amount of money into private equity. Let's just take that for a moment. And within that amount of money over a period of time, you will find the right entry point on behalf of the investor based on a certain metric that you have, and you will buy into that company, but you will buy a number of companies. So it may be 8, maybe 10, maybe whatever it is. And that's supposed to offer some kind of diversification. Now, certainly diversification from maybe industry, economic sectors, or even size, and so on. Can you talk a little bit about how that works? And when something is favorable, it always strikes me, something is favorable. Let's say banks for a moment. Yeah. I'm just using that for a moment. Right now, because of the Silicon Valley Bank, there are a lot of other small, mid-sized banks are under pressure, and they are otherwise financially sound. It's just the market is not giving them a good value. And some of them are, let's say, we're able to buy them on the cheap. So if that's on the cheap, I will end up buying more. How do we diversify when not every industry is necessarily in the right place, but yet you want to diversify so that we are not concentrating our investment in any one manager in any one industry?
Right. No, I think the points that you made were very relevant, which is you're trying to get diversification from industry, sector, subsector, geography, right. Yep. and so on and so forth. You can never call the vintage or the time that you purchased if it's good or bad unless you're looking backwards. And Philip, exactly to your point, generally when you think about a lot of these strategies, these are 8, 10, 12-year types of investments, yeah. Whereby if you look to commit a certain amount of money, you have anywhere from 3 to 5 years, or we as the asset manager, to deploy that capital. And then generally we harvest that capital over the back 5 to 7 years. So from our perspective, because we don't have a crystal ball, our general view is you want to own access to that asset class, but you can't bet everything on any single vintage year. You might be able to overweight or underweight, Philip, to your point, where there might be more stress or more distress, right? But at the end of the day, our view is you want to stay invested, you want to have exposure, and you want to have diversified exposure with managers that really are committed to the space and have core expertise in this space.
So one strategy then, based on what you are sharing with me right now, is perhaps I want to commit, I'm just using a round number, $1 million to private equity. I may do that over 5 years, over 5 vintages. So I'm using just a simple math, $200,000 a year, this vintage meaning this year, and then next year I will put another 200. So over 5 years, I have fully invested $1 million. And by then, the first vintage is almost coming time to start distributing. and then I can reinvest that in the next vintage. So it's like almost like a rolling process. Would that make sense?
Yeah, that's right. I mean, that's generally correct. I mean, I would say the one thing being is as you think about the later vintages, you might already start to get a harvesting of your investments or some of your cash back from some of your early vintages. But I do think from our standpoint, it is really important to diversify your vintages, given the fact that we don't have a crystal ball.
Right. And I know your paycheck is cut by Apollo, so you can answer this question one way or the other if you want to. Does it not make sense that Apollo is famous for certain style, and there may be others who are famous for other styles? Does it make sense to use a number of firms like yours who are all brilliant and say, well, not only I am going to diversify through that, I'm also diversifying my managers, no different than a public market?
Of course, I'd like to say 100% of one's portfolio should be an Apollo.
Thank you. We can move on.
but when you think about Apollo in terms of what we're very, very strong at, the roots of the firm started in private equity. It's a very large franchise of ours. We're the largest alternative credit manager in the world. In addition to that, we have core expertise in what I'm going to call hybrid capital and real asset investing, right? Mm-hmm. But I do think that the bigger conversation is more to your point is how do we think about portfolio optimization? How do we think about risk? And how do we think about diversifying manager risk? So from our perspective, you don't need to have 20 different GPs or asset managers. You probably want to find those 2 or 3 GPs that you have a high degree of confidence in. Yeah. And then you want to have them as partners when you think about investing across the different asset classes. So you don't want too few, like one, but you don't want too many. Yeah. So from our perspective, you want a couple of really good GPs to provide you with the exposure that you're looking for.
So one other question about this diversification. I think diversification is the only quote unquote free lunch in investment.
Away from the one that I buy you, of course.
Of course. Let me ask this question. Is there a case with private investment alternative also where to diversify, you end up not getting the kind of return? In other words, in public market, we know that, we buy every mutual fund known to man. I'm fully diversified. Yeah, you're getting absolutely no alpha at all. But it doesn't necessarily sound that way in private because, and I want to sort of drill down on that a little bit and what makes private unique. But is there a situation where you say, well, gee, you said, one is too few, 10 is too many, perhaps, but 3 or 4 makes sense. Is it part of that is about proper diversification, or is it just too much for us in my space to have to live and breathe that stuff 24/7 to make sure they are on track, or what is it that you feel?
It really goes back to your earlier question, which it's about finding that manager or 2 or 3 that are really good at what they do. Mm-hmm. And by having a couple of different GPs, you'll be able to get broad diversification. But I do think, to some of my earlier comments, which is the benefit of going into private markets is the fact that there's alpha. So you want to be aligned with managers that take views, that take positions, that invest in where they think they could generate alpha in a consistent, persistent fashion. So I don't think it's all too different than, let's say, the public market per se, but given the fact that there is a lot more alpha on the private side, you really want to spend a lot more attention or spend a lot more time on the GPs that you're aligned with.
So let's go back and talk about alpha for a moment. I don't think, Jason, I'm looking at you. You have this one head, 2 eyes, 2 ears, 1 mouth, 2 nostrils. I don't see you, but just looking at you, I would say, boy, you are just Mr. Alpha nonstop, right? So what is it that you think that makes private market in private equity, just to focus on that for a moment, because private debt is a whole new world, that gives that kind of alpha? Is it knowledge? Is it opportunity set different? What is it that makes private equity that's superior to public equity over time?
I would say it's the opportunity set, number one. I think number two, it's less trafficked than, let's say, the public market. So there's more of an opportunity set. Number three, if you think about a company, right? You buy, you fix it, you sell it. There's more operational control that you could do with that. The same, obviously, on the debt side. And then I would say that the last thing, be it is the fact that when you think about privates versus publics, the access points to it.
The access point.
Yes.
So when you talk about opportunity set and all that, it's really, you're saying that it is more inefficiencies in the private market space.
There's less inefficiencies, and as I mentioned, there's less people trafficking in it.
Yeah.
And then last but not least, right, unlike public markets, these are illiquid assets.
Yes.
So there's structural alpha, also called illiquidity premium, associated with the private markets versus the public markets.
So what you're saying is, and I think I know illiquidity premium. In other words, if I'm an investor and I'm going to have my money tied up for a long time, I expect a little higher return. And then if I can get my money anytime, any day, that right. has to have some compensation for tying up my investment dollars.
That's spot on.
Right. And what about complexity premium? In other words, is where you know that very well. I just want to explain it. That these deals, these acquisitions, this analysis, and so on and so forth, in the private market is not as easy as here's big data, go look it up, and what the public documents. This is actually a lot of tire kicking, a lot of work, and sometimes can be quite complex on how you structure the deals. And is that a deterrent for some and really embracement by others, and those who are willing to embrace the complexity are rewarded for that? Is that a fair statement?
Very fair. And here at Apollo, we embrace complexity, and that certainly plays into the alpha proposition that we've been able to deliver on over many, many years.
So number one, opportunity set. Number two, illiquidity. And number three, complexity. Those are the main three things that should give rise to an expected higher return, or we want a higher return to go through those three things. And with the right manager, they have consistently been able to deliver. We go back to this question, though, Jason, that I asked you earlier, and I don't think we're completely exhausted the answer. Is what makes you believe, or what are some of the evidence that you see that you think that private equity and private markets going forward in a very different existing monetary framework is going to continue to derive and to drive above average return to compensate us for those two, complexity and illiquidity premium?
I think it's for all the reasons you mentioned, right? Which is complexity coupled with the illiquidity premium, and given the fact that there's a lot of different operational items that we can do to companies to make them better.
And what about the leverage aspect? It costs more for you to do your business. It costs them more to pay you for that. Are they in debt or in equity? Does that in any way become very get to a point it becomes challenging? I mean, maybe not at 4%, maybe at 8%, maybe at I mean, there is a ceiling, I assume, that people are willing to pay. And then as you get closer to that, the less you're able to harvest off that ceiling, the ceiling gets higher. Am I speaking correctly, or am I thinking erroneously?
I think, at the end of the day, you're going to see repricing. As you start to see cost of financing change, be it higher or lower, you're going to see repricing of risk. And that's going to take place, Philip. Candidly, it doesn't matter if it's in the public markets or in the private markets. So you're going to see it across the financial markets and the capital markets landscape.
But in the private market, there is an advantage because we can't touch that money because of illiquidity. It allows us to minimize behavioral biases. Is that a fair thought?
That's correct. And if you think about, one of the benefits of the liquid markets or the public markets is the liquidity feature, right? Which is if you want to move around risk or move around positions, you could do it. And in 2 days, you're going to get your money in your account. But there's also negatives to that, right? Because if you think about it, many times, at least, I've heard many clients tell me, we're long-term investors.
Sure.
But when markets start to go down and they start to go down quickly, a lot of those long-term investors become short-term traders.
Yes.
And as we know, investing and wealth creation, long-term wealth creation, happens over a cycle. And unfortunately, what happens in many instances, these long-term investors become short-term traders, and they get out of the worst possible time because they have that liquidity feature, but they unfortunately don't ride the upward swing. So at the end of the day, we believe that a lot of clients love liquidity and value liquidity, but they overpay for that liquidity. That's
Understood.
why when we think about how to build better portfolios, it's about the marriage of both public and privates together should yield better results for clients. And what are better results? That should mean clients should get higher total returns, more income, higher Sharpe ratios, higher Sortino ratios, and just a smoother experience over that full market cycle.
I have to look up a dictionary to go through all those proper names, so I'm going to ask for your forgiveness.
Higher is better than lower.
I'm going to ask for your forgiveness. Yes, of course. I think all those are important, and those are critical points. I'm going to bring up one more thing, and I'd like to go to the 60-40 and how we think about portfolio construction, and how do we make these available from your thinking to the masses. So I think that's really important. So before I go there, I think that you are very familiar with interval funds. I think that you were party to generating those even I think in Goldman days. But the interval funds is a bastardization of private public. In other words, look, we want to be able to do both. We want to give you liquidity, but at the same time give you some of the benefits of illiquidity premium and complexity. And overall, I don't think it has been an overnight success. Some have done better than others. But because of this tug of war between liquidity and illiquidity, I don't think we're really getting the best of both. We're kind of getting a bit of each. And at least that's my observation. Tell me, do you feel the same way or you do not?
I think over the last couple of years, and we're just in the very beginnings of this, you're starting and clients are getting the benefit of this. But I think, Philip, you raised such a great point, and obviously all the points you raised are phenomenal and worthwhile. But I do think it's important for us to take the view of what are structures from a 50,000-foot lens. You have on one side of the ledger, you have liquid structures, e.g. mutual funds and ETFs. On the other side of the ledger are those 10-year locked-up structures that we've spoken about. But what we're seeing right now in the middle is what I call the less liquid structures, right? Structures, as you mentioned, interval fund being one type of structure, but less liquid structures generally are strategies or structures whereby clients can subscribe either daily or monthly, and these strategies are generally quarterly redeemable up to some cap. But they come in many different names. It could be an interval fund structure. It could be a business development company like a BDC. It could be a non-trader REIT and others on a global-wide basis. So from our point of view, if clients really value liquidity and that's what they value, that's when you go to the public markets and you look at mutual funds and ETFs. If clients are looking to value more of alpha and return and some level of liquidity, that's where you go to these less liquid structures, or as you mentioned, Philip, these interval funds. And that structural alpha, because of the liquidity premium, the complexity premium, and other things that you mentioned, should generate somewhere between 200 to 500 basis points of structural alpha over that of those liquid structures. And then if clients are saying, I don't need any liquidity, that's when you go to more of those illiquid structures where there should be a couple hundred basis points of more structural alpha than that of the less liquid structures. So from our standpoint, when we think about this space and we think about democratization of alternatives, and what gets us so excited is you're going to see a lot more of this less liquid or semi-liquid structures come evolve in the future.
Great. This is the direction I want to go, because this is where I don't think I have to say anymore. And then it's like a wind you up and then you are just going to go on democratization. So I'm going to see if I can wind you up for a moment. But before I do that, let's talk a little bit about the 60-40. And last year there was this pronouncement, the debt of 60-40, which I did not buy into, and I still don't buy into it. Just because 1 year the correlation was 100% does not make 60-40 a failure, because we don't just invest for 1 year. However, with that said, it is also going to be a very different 60-40 portfolio if we have alternatives in it, because alternatives, again, it's not priced mark to market every day. Behavioral bias is removed or just not available for them. But also because of the type of things that we talked about, it is less sensitive to the type of public market hiccups. So how should we think about 60-40? I'm not going to ask you, which part of the bucket we farm things out. I mean, there's no end to that discussion. Totally. That's not where I'm going. But really saying, is it fair for a framework that if you intend to allocate 60% to equity and 40% to anything other than equity, such as a bond or credit, whatever you want to call it, fixed income. Out of that 60, how much of that should be in private, how much of it in public? And I won't ask you what that is because everybody's different. The liquidity requirement is different. The risk tolerance is different, so on and so forth. But is that the framework that we should be thinking about? You still stay the 60-40, but constitution, what is the constituent to that 60 changes.
Yep.
And changes in a meaningful way. Is that how you think about that? How you would advise clients or advisors or intermediaries?
That's absolutely right. If you think about it, for decades, the 60-40 provided generally, call it high single-digit types of returns, but lower volatility because you introduced different risk factors into the overall composition. You had interest rate sensitivity, you had credit risk, you have equity risk premium, and others, right? So this diversified basket of risk produced really good returns for clients and also a very good risk-adjusted return. But exactly to your point, when we think about the market environment where we are and the go forward, we are concerned that the diversification benefits are going to be a lot more correlated, number one, and the future return stream is going to be a lot lower. Yep. And that's why, Philip, to your point, and I think this is what you're getting at, we think in order to generate differentiated return streams and differentiated returns and better risk-adjusted returns, the inclusion of private markets risk or exposures into the 60-40 is not a nice to have, it's a must. So from our standpoint, and you're absolutely right, 60-40, we could speak about it, but we can envision over time that half of the 60 and half of the 40 will be made up of private markets exposure, a la, broad alternatives.
So let's go to this democratization, because that's really what is so important, because we are not, our clients are not all billionaires. And so they have a liquidity need. And as America ages, which becomes even a bigger issue, that is less psychologically ready to tie up their capital and look for a return over a very long time. They don't feel that they are going to live long enough to see it, and they need current income. So I think a combination of public and private makes a lot of sense, but specifically on private, I happen to have some knowledge of some of the things that Apollo has done. And again, this is not about Apollo product. This is really about the way you are thinking in terms of more permanent capital, more capital that you have created ideas that allow some semblance of liquidity, either on a quarterly basis or what have you. Can you talk sort of in very general terms about how that is becoming, like you said, it's not the two extreme, fully liquid or not liquid at all, but it's really in the middle, and how we can provide some amount of liquidity that can satisfy the aging population who are looking for that enhanced return during their lifetime?
Yeah, no, that's spot on. And you're right. The aging population is real, and the need for longevity of income is really, really important. And I think exactly to your point, we have strategies whereby it's a marriage of both private assets and public assets together, where you typically have it as like that 70-30 or that 80-20, where 70 to 80% of the portfolio is in direct origination, first lien, floating rate assets, top of the cap structure, and they're downside protected, and 20 to 30% of the portfolio is in public markets.
Yeah.
The combination of that private and public together affords clients a couple hundred basis points more of yield relative to just public alternatives. In addition to that, it's more downside protected, given the fact that we're able to introduce different risks in the portfolio. And then last but not least, which we think is really interesting, strategies like this can be consumed by clients really of any suitability. And I think that's really important because, from the beginning of our conversations, when I went through some of the stats, if you go back a couple of years ago, ultra high net worth, as I mentioned, went from about 0 to about 5% of private assets. When you look at the mass affluent or clients that are accredited below, it's a really small number, and it probably rounds to 0. So strategies, at least on the credit side, that blend private and public together clients, regardless of the suitability, can have access to strategies like this. So this is one of those steps to the democratization of alternatives. And Phil, to your point, if you're able to get 1 or 2% more total return per year, and you're able to have the same volatility profile, if not lower, and you compound that, that really will be a great solution or part of the solution toolkit, said differently, for retirees and also for clients that are trying to build long-term wealth creation over a full market cycle.
So that sounds almost like a reversal of interval fund, where 80 liquid and 20 illiquid, you turn it around. 80 liquid, 20 liquid, is that 20 that allow you some liquidity, but it's the 80 that's doing the heavy lifting to give you the 100 to 200 basis point a premium of income. Is that, am I hearing you correctly?
I think you're right, and you're definitely hearing me correct. But I think you're thinking about it correct. But what I would say, given the fact that you have GPs like Apollo coming into this space and really trying to lead the charge on democratization alternatives and really trying to lead the charge in terms of the educational aspect of the benefits of alternatives, you'll note that it doesn't matter to us if it's an interval fund structure, a BDC structure, really any of these other less liquid structures I've described. You should always view it as that 70-30 or 80-20 is what you should be accustomed to. But you're absolutely right, Philip, that when you look at what I'm going to call the older vintages of the interval funds, they generally were public risk or public securities with maybe like 10%, if that, in private structures. But I'll tell you, at least at Apollo, as we think about the democratization of alternatives, you'll find that in our interval fund structures or any of our other structures, much, much higher allocations to private allocations and private investments over time.
Because otherwise you are diluted out. Why bother?
And then why pay active management fees? Go to beta. Pay beta fees. The reason why you come to a GP like Apollo, especially in credit, as I mentioned earlier, it's because we're able to give you differentiated risk, and that differentiated risk comes in two formats. Number one is the structural alpha that we provide you from the private investment, and then the security selection and the outperformance that we're able to drive over a market cycle on the public side of things.
So structural alpha is the alpha that is in the system, and then you add more value to it.
That's right. But it's just been hard to access it. And that's the problem. It's been hard. But, we, like some of our peers, are looking to democratize that.
So finally, time is just running by too quickly. Jason, there's so much to learn from you, seriously, on this matter. Are you also thinking about injecting private into retirement investment assets for the defined contribution plan? Because that's a tremendous amount of capital there. Trillions of dollars that really needs to grow a little bit faster, especially as you mentioned, and I totally agree with you that the future return is going to be sub double digit for sure, with a high degree of certainty based on what we are seeing, at least in the next economic cycle, and that we need to really help Americans to save for retirement, and we don't have 30, 40 years to do it. We have, time is compressing. How are you thinking about that, or are you thinking about that?
100% thinking about it. We think about this every single day, and it's part of the journey. It's part of the democratization of alternatives, be it in the taxable side or more in a tax-efficient wrapper like the DC market, as you very well mentioned. There's some, regulatory barriers and challenges that are getting better. And there's also a lot of features from a product design standpoint that are also getting better. So, Philip, to answer your question, we and I are extremely focused on the DC marketplace, and we do believe that over time, the DC market will have a lot more adoption of these strategies.
So I think that DC marketplace, you can actually able to put vis-a-vis fiduciary risk are two separate things. So let me make it very clear that I believe you can actually put tradable interval funds if you do it right, and you have the right plan, you have the right plan sponsor, you have the right intermediary who advocates for it. Do you anticipate, just a thought, of leveraging managed account as a way to dial in the right type and amount with clear boundaries and guidelines of alternatives?
Yes. And, a lot of clients I'm dealing with are looking at the managed account options as a way or an easier way to blend public exposures and private exposures together based upon a client's risk profile.
And then also in the target date fund space, injecting private markets into a portfolio that is made up of everything else liquid and allowing that liquidity, full liquidity, even though it's embedded illiquidity. Is that something that also makes sense?
Every strategy and structure is a little nuanced, but I would say the inclusion of alternatives to our target date will absolutely happen, is happening. What you'll find is from a product standpoint, more multi-asset solutions are probably more appropriate for target date strategies, but you're seeing it and you're going to see a lot more of that in the future.
So in conclusion, Jason, after you have taught me all these, would you share with me the 2 or 3 things as I leave this call with you and hopefully have another good opportunity to speak with you again at another session to get more educated? What are those 2-3 things that you want to impress on me before I sign off?
I mean, only 2 or 3. I thought you'd give me a list of, let me allow to have a list of 10. I'd say a couple of things, not in any particular order, but Philip, I just want to say on behalf of myself and Apollo, it's a pleasure to be part of this. So thank you, number one.
Thank you.
I think number 2 is the democratization of alternatives is real and it's happening. We are very focused on leading the way, and it's part of it is product. Part of it is training and knowledge share, and part of it is removing the friction points associated with the clients to gain access to all alternatives. And I'd say the last thing, more from a broad market point of view, which is exactly to your point, Philip, which is traditional investing is challenged. Forward returns are going to be lower. Vol's probably going to be higher, especially as we see the interest rate environment and monetary policy on a global-wide basis change. From our perspective, the inclusion of alternatives into our broader portfolio will just lead to better outcomes over a full market cycle.
If there's anything I think I can do on our industry side, at least just lonely person of one myself, is to be better educated about your space, to be able to better express what it is to our clients so that we can align all our interests together in the same direction with proper expectation and to give the time for it to realize its benefits.
Philip, I can make that very easy for you. ApolloAcademy.com.
Apollo Academy. Is that a paid site?
It is a site. We don't speak about Apollo products. It's really about leading the charge to educate clients about alternatives, asset classes across the spectrum. So again, ApolloAcademy.com, you'll find most of your answers. Thank you so much.
Jason, thanks for spending almost an hour with me. And I know your time is very precious and there's a lot of demand on you. And I don't want to take this lightly. So appreciate it. And thank you for your time and your wisdom. And I look forward to spending more time with you in the near future.
My pleasure. Thank you for your time. Great to be here.
Have a good afternoon. Yeah.
Cheers. All the best.
Thank you. You can always find more episodes by visiting philipchow.us/podcast or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchow.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.